both gold and silver are edging higher and higher versus the S&P 500. So that means you see some of the purchasing power leak out of you say it, not mainstream portfolios, classic portfolios going into gold and silver, and this hasn't stopped since the beginning of 2025. It's going.
Hmm.
And sometimes it goes a little bit out of control, like it did at the end of January, and then corrects back. And on February 1st, February 2nd, when you saw the gold and silver crash, but still the trend line is pretty securely up versus stocks.
Personally, I think silver is headed higher.
Yeah. Yeah.
It's broken above. This is the next minor level of resistance at 87.51, and it's at 86.98, so not that far. And then, of course, this is major resistance at 97 to $100 per ounce. I think silver's moving higher.
Gold prices have surged 74% over the past year and 201% over 5 years, outperforming stocks. Financial analysts say gold can be an effective diversifier in investment portfolios, as the gold and stock markets often move in opposite directions. Although silver tends to be more volatile than gold, it has historically experienced sharp rallies during precious metals bull markets. During the 2008 to 2011 cycle, for example, silver prices rose significantly as investors sought hard assets amid financial market turmoil. If inflation remains elevated or economic uncertainty intensifies, investor demand for physical silver could increase again. Renowned financial analyst Rafi Farber and GaryWagner analyzes gold and silver markets, focusing on how inflation, debt expansion, and monetary policy influence the long-term value of hard assets. The most critical part of Rafi Farber's analysis is the relative performance of precious metals against the broader stock market. He observes a trend where purchasing power is leaking out of classic portfolios and tech stocks into metals. Regarding the intersection of geopolitical conflict and market mechanics, Rafi Farber provides a sobering perspective on why the obvious trade isn't always the right one. We are currently in a phase of the business cycle where war acts as a catalyst for an already fragile credit system. Farber challenges the superficial reasoning that gold always rises during a crisis. He predicts that gold and silver might face downward pressure in dollar terms for a few weeks as this dash for cash plays out. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Rafi Farber and GaryWagner's recent interview.
I don't know what happens in dollar terms. I think we're going to have to wait for the dust to settle, and it's going to take a while. But if you look at the charts of silver and gold versus stocks versus the S&P 500, they keep inching higher. I mean, both gold and silver are edging higher and higher versus the S&P 500. So that means you see some of the purchasing power leak out of you say it, not mainstream portfolios, classic portfolios going into gold and silver, and this hasn't stopped since the beginning of 2025. It's going.
Hmm.
And sometimes it goes a little bit out of control, like it did at the end of January, and then corrects back. And on February 1st, February 2nd, when you saw the gold and silver crash, but still the trend line is pretty securely up versus stocks. And that could mean that in dollar terms, gold and silver might go down. But I think the trend is going to be that S&P 500 and other mainstream tech stocks and others, the bubbly stuff, it's going to go down even faster. That's where we are in the business cycle. We saw, what is it, this thing called private credit blow up. There was a company in London, something market solutions, that
Yeah.
they borrow money from Wall Street and they lend it to business development companies. It doesn't even matter. It's all the same model of trying to look for yield out on the credit safety score. The more risky your loans are, the higher interest you get for it. So then you have secondary investors investing in these riskier loans because you can't get any yield on the safe stuff. So what's the point? But it's all the same model. And we're in that part of the business cycle, war or not, where the long end of the risk curve is starting to break down.
Right.
And I expect that to continue until it reaches a critical mass, and then you see this wave of defaults go into the center, and then the Fed's going to have to act. And all things being equal, war tends to speed that up because it just eats capital. If you look at the history of the breakouts of different wars, what tends to happen is that oil jumps for a few days and then falls. And that's what happened in 2022 with Russia, right? Russia invaded Ukraine. And then oil spiked to, it was in the triple digits somewhere. And then by March 7th, that was the high, and then it went down after that. And gold, it feels like it should go up because that's the superficial reasoning. Like now there's uncertainty, so you go to gold. But really, when there's uncertainty, you go to the dollar because you need immediate liquidity when you don't know what's going on. So there's a rush for dollars, and people sell everything, including gold and silver, and then the dollar gets a bid. The dollar isn't getting that much of a bid, but it's getting somewhat of a bid because in war you want the primary monetary asset. Not I'm not saying that dollars are money; they're credit, but in a crisis, even if you're a stacker, you still want some cash on hand because you don't know what's going to happen. So in the immediate aftermath, gold usually goes down, in the short term, maybe a few weeks, maybe a month. I don't know exactly how long it's going to be, but the monetary consequences of this war, they're gonna be felt, and a lot of you have to spend a lot of money to blow up a bunch of stuff and then build more bombs.
Right.
So someone's gonna have to pay for it, and we're gonna pay for it through higher prices. Whether that's gonna be because oil is just gonna keep going higher and higher because the Straits of Hormuz are blocked or something. I don't think that's gonna happen because Iran pretty much they lost their whole navy. It was all blown up by Israel and America over the last few days.
Hmm.
So that they're done. I mean, they can still shoot missiles into the straits, and that deters insurance companies from covering tankers, so they won't go unless they're assured that that's not going to happen. So I think that'll be resolved in the next few days, and then you'll see oil start to fall. And then after that, we'll go back to life as usual. I'm not saying it's going to be completely stopped. I mean, I would like it to be because like
Right.
I'm in the middle of a war zone, but I don't think it's going to be one and done or just a few days. Though I did get some kind of insider information from a friend of mine who says that he has a CAA contact aboard one of the aircraft carriers that said the first 10 days of the war are going to be intense, and then after that, it's not going to be as bad.
GaryWagner argues that while many traders were distracted by technical sell signals, the true driver of the recent price action was a strategic flight to the dollar, triggered by geopolitical instability. He observes that while gold struggled with this rotation, silver has shown a unique internal strength, recovering much of its losses and even trading higher on days when gold was down massively. Despite silver's deep correction, Wagner remains structurally bullish. He mentions that the move from $46 to $121 was so massive that a deep retracement was mathematically expected. Investor demand plays a powerful role in determining silver's price direction. During periods of financial instability, geopolitical tension, or persistent inflation, many investors seek tangible assets as a hedge against uncertainty. Silver, like gold, has a long history as a store of value during times of currency debasement or economic stress. Concurrently, he concludes that these are acceptable corrections that do not represent a pivot from bullish to bearish. Instead, he views this as a healthy pause in a sustainable bull market. Let's jump into the interview.
The one thing that we have noticed, it's been reported by multiple news stations, is at first many investors and traders believed that the recent downside in gold was due to technical selling. That explains some of it, but it's why they were technically selling. And that is in times of crisis, one, specifically with oil moving higher, and the chance that the Fed is not going to be as accommodative with rate cuts, they seem to be moving large amounts of gold back into dollars. Mm-hmm. And we've seen that in dollar strength. We've seen that in the decline of gold. Silver's kind of acted on its own, whereas gold was down massively yesterday in Australia and has recovered at least 50%. Silver's tugging along and actually trading higher on the day.
Yeah.
The question is, excuse me, if this is going to be a short event or an elongated, protracted event, because each of those scenarios carries different possibilities in terms of where we're going to see the metals move, the dollar move, and specifically oil. Oil obviously is a big thing. The Strait of Hormuz is effectively closed, and that could change at any moment. And that's going to be a big deciding factor when we see these markets pivot. In terms of gold, there's very strong support at 5,000. When we look, I've got gold on both sides because I want to put different studies up later if time permits. But we've seen gold wick down to 59 or 5,011 here, and then here to 5,024. But the real bodies, meaning the relationship between the open and closing price on a candlestick, of course, if it's red, it means it closes lower. Green means it closes higher. But you've had these bodies sitting just below 5,100, and that is where I am pegging a major level of support. I tend not to count the wicks because these are unsustainable lows on the downside or unsustainable highs on the upside, as we see right here. So I look for where the real bodies are either opening or closing, and it's right below 5,100. So if I do a fib retracement from silver when it's at 48.50 up to the high of about 121, what we're going to find is, and let me move these averages up. What you'll find is the market comes down and then it really goes between a 61 and a 78% correction. That's an extremely deep correction. But then considering that silver moved from $46 to 121, deep correction can be expected. The interesting thing is if I do a Fibonacci retracement from this low here, this wick, to here, this is also about a 61.8% retracement. So we're seeing deep corrections, but in all cases, these corrections are acceptable in terms of they don't represent a pivot from bullish to bearish, but rather a correction within a bullish market that is still sustainable. And that's what I find is interesting right now. Personally, I think silver is headed higher. It's broken above. This is the next minor level of resistance at 87.51, and it's at 86.98, so not that far. And then, of course, this is major resistance at 97 to $100 per ounce. I think silver's moving higher. What you want to do is take your strategy and refine it so that it is not as susceptible or risk. There's not that much risk that comes in when you have these crazy moves. One thing, let's take it back to what we do, which is the precious metals. I have recommended to our traders in our premium group that besides trading, they want to begin, if they haven't already, to continue to accumulate physical gold because you're going to hold that for a long period of time. You can't, stops can't get executed. It's not that you're not worried about day to day, but you can weather a storm if you believe that once the storm has cleared, that the metal will return to upside movement. So that's one recommendation. Another one is to move into GLD and things that are not leveraged, because when you have increased volatility and major volatility, sometimes the futures markets become extremely volatile and difficult to trade with any kind of realistic risk-reward ratio that makes sense. So those are the things that you really want to look at. And that's what I talk about with my clients, alternate strategies for unique times. And that's what we have.
With gold already outperforming stocks in recent years and silver historically delivering explosive moves during metals bull cycles, both analysts believe the broader trend still favors precious metals as investors seek diversification and protection against economic uncertainty. If global uncertainty, inflation risks, and currency instability continue to grow, could the next wave of investor demand push silver into another powerful rally similar to past precious metals bull markets? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.